Okay, so chapter 11 introduces you to standard costs and something called a variance, which are very important to sort of understand. And chapter 11 ends with an introduction to some of those variance reports that you'll be learning, and something called a balanced scorecard, which is an important concept, and we'll get to that in your next class. But today's class, we're going to be focusing on the first two objectives, describing what we call a standard cost, and then looking at variances related to direct materials. So here we go. So we've been talking a lot about budgets in the last few chapters, and you all have seen how budgets look at a total amount, right? Um, well, we're going to look at something called a standard today in this particular part of the chapter, and understand it as a little bit different than budgets. But whether we talk about a standard or a budget, we are looking at a predetermined cost, and it sort of helps management plan what to expect and then how to control all of that type of thing. Just the difference you have to know is a budget is for a total amount to get something done, for example, where a standard is simply about a unit amount to get one unit done. Okay. So that's where we're going to be focused on standards here. There are a lot of advantages to using standard costs, particularly for management. So it helps for planning. It promotes greater cost consciousness among employees because everyone can understand that one unit costs a certain amount as a standard. It's also very useful these are costs, but you got to go ahead and sell your product. And so it's very useful in setting appropriate prices to sell your finished goods, because obviously you want to make as large a profit margin as you can. It helps managers to control various things by setting a standard and comparing it to actual results. Right. It's very, very good because with management by exception, they're looking at those exceptions. Favorable and unfavorable also is something we use in variances. And so again, this is very, very helpful when you have this. And it also helps to simplify costing when it comes to inventory, which is important. So in terms of setting a standard cost, this is this is management's job to do that, but it requires input from all the people who are involved or have responsibility for either understanding the quantities that are necessary to get something done and the costs involved with those quantities to get something done. And so this is important to understand. So standards are basically set with all this particular information. Management has a few choices to make. And again, companies do set standards. I don't know, they say it's at one of two levels, but it's really at just one level. First of all, this idea of an ideal standard really represents the very best performance under perfect operating conditions. And I don't know about you, you're old enough to know that life is not optimal, and that there's nothing that's quite perfect. And so ideal standards are not used in general when setting standard costs. What they do, management always uses normal standards, because normal standards say if we have an efficient level of performance, then we should be able to to get a few things done under the normal way or expected way things operate. And so basically speaking, normal standards tends to be the standard. Okay. Which is, as the word says, normal. Okay. Because why? Ideal standards are just not ideal enough. Okay. So again, normal standards should be rigorous, but they need to be able to get achieved. Otherwise, you're not going to get the right costs. You're not going to get the right things done as a business if you're dealing with ideals. Okay. So at a normal level of activity, you set the standards from that. This is a little, vignette in your book about how standards help businesses. And again, there is something called, there's a group that's organized that's called the Open Standards Benchmarking Collaborative. And they actually are really, really good regarding sharing information about performance standards in their particular industry. And it's very interesting that other companies will look at these as benchmarks. So your book kind of introduces you to that a little bit, but not much we're going to use here. Let's look at a case study. If you have your book with you, we're on page 468 to be looking through this case study of setting standard costs. Okay, and again, we're going to go look at our things that we've been dealing with in this class since day one: direct materials, direct labor, and overhead. Okay, things that you're quite familiar with at this time. So it's necessary that companies look at and set standard costs for all three of these elements. Okay, let's see how they do it. For direct materials, their price standard is the cost per unit that should be incurred, right? What's expected under normal circumstances. Right? And so for this particular item, and I don't know what this item is, you have a regular purchase price plus the freight plus receiving and handling. And when you look at it on a per pound basis, the standard direct material price is $3 per pound. So that's the standard they're going to use for direct materials. The price is only one aspect of making something. They need to know how much quantity in order to set a standard to make something. So the direct materials quantity standard, right, is the amount of quantity that should be used under normal circumstances per unit. To make one unit, this is the normal amount of quantity used. This is the standard. So they look at required materials. They also have some allowances for waste and spoilage. So the standard direct material quantity per unit is 4 pounds. So if they're going to be using 4 pounds as a standard unit, and each of those pounds have a standard price of $3, right? That was from the last slide. Then their standard cost for materials, direct materials, is $12. So this you have to remember, right? Because you're going to see this pop up again. And this, by the way, we're at the top of page 469, if you're following along. So the direct materials price standard should include an amount for everything except normal spoilage. Not something that's critical to know, but it is counted in. So the delect, yes, it's a DI and elect here. Direct labor price standard. Okay, again, it's a price. The rate per hour that's normally incurred or should be incurred for direct labor. Okay. They also call it, as you see here, the direct labor rate standard. So instead of price, they use rate. So, and then this is per hour. So you have an hourly rate, and plus you might have a few other costs for the employer, cost of living, payroll tax, any fringe benefits they pay, and that they get a standard direct labor rate per hour of $15 per hour. That's the rate. Well, how much quantity is needed to make? How much labor do we need in terms of quantity to make an item, right? Because standard cost looks at each unit, right? So what type of time is required to make one unit? Well, as you see here, between setup and breakdowns and a little bit of cleaning up and so forth, they've set it for 2 labor hours for each unit. So if you have 2 labor hours a unit, and you just realize that the standard price for those labor hours is 15, you got $30 in standard labor costs to produce one of those units. Okay. So now we figured out 2 things already: direct materials, and now we figured out direct labor. Okay. The last thing is overhead. So manufacturing overhead, companies use a standard predetermined overhead rate. Okay. And calculating that overhead rate here, as you see, is the amount of overhead divided by usually some activity index, right? Like direct labor hours, for example. Okay. So in this example, the company expects to produce 13,200 gallons of whatever, right, at normal capacity. And it takes 2 direct labor hours for each gallon to be produced. So here are the budgeted overhead costs. Variable is listed first, fixed costs are listed second. Okay. Of course, over a 2-hour period, they're going to be producing well, their standard direct labor hours would be 2 times 13,200, which is the 26.4 that's listed here. So when you have variable costs of 79,200 and you divide it by the labor hours, which are, this is the calculation that's used here, 26,400. That means the overhead rate per direct labor hour for variable is $3. For fixed, it's $2. So for the total amount of overhead, $5 per direct labor hour. Okay. And because it takes 2 labor hours to create one of these things, $10. $5 an hour, that's per labor hour, but it takes 2. It takes 2. So there we have the total. We have direct labor. Remember, this is from early, a few slides back. We said it was going to take 4 pounds would be the standard quantity. This is important to know. Standard quantity, standard price. These terms are important to know. So you have 4 pounds of materials at $3 a pound. $12 in direct materials is the standard cost for direct materials. Direct labor 2 hours of direct labor, $15 an hour. We saw that in about 2 slides ago. $30 standard cost for direct labor. And we just calculated the manufacturing overhead, which is also based on 2 hours, $5 an hour, $10. So the total standard cost for every gallon of this, oh, here it is, Zonic tonic that they have in your book here. It's $52 total standard cost per unit. And the total standard cost, as you see here, is the sum of the direct materials and the direct labor and the manufacturing overhead. Okay. And so you do it, your learning objective 1 is basically ends with this. It's just a matter of, can you understand how to calculate the standard costs? So here they have an example for you. If you have your book and want to look at this, this is the top of page 471. So if you're on page 471, you will see Reddit Incorporated. They have the following standard cost data concerning their product CTY 31. So that's the product number. Okay. So they have materials. So this is direct materials, 1.5 pounds at $4 a pound. So direct materials here, 1.5 pounds at $4 a pound. So the standard cost is $6 per unit for material. For labor hour, they need 1/4 of an hour, so 15 minutes to put one of these things together at $13 an hour. So direct labor, 1/4 hour times 13 gives you $3.25. Manufacturing overhead is 120% of direct labor costs. Okay, so first of all, we have to calculate the labor cost as a standard cost. So it's this $3.25. And direct manufacturing overhead is 120% of that. So you take 325 and multiply it by 1.2, and you'll get $3.90 as your manufacturing overhead per unit, again, for 1 unit. Right. So to create the total cost for one, this is the standard cost for 1 unit, are all of these added together, $13.15 for 1 unit. I'm coming back to our big screen now and asking if there's any general questions on learning objective 1.